Hi, Brian, with your Mortgage Insider Edge this week. As stocks turn, maybe interest rates will follow. We're going to dive in. So today the S&P 500 is down 63 points. I have a chart going back to January just for reference here. We hit some lows back in March, and then the stock market bounced back up, and then just the last couple of days of major news out of Russia, the potential for kickback, I would think pushback from Russia in particular during the Ukraine war, and the United States and the United Kingdom and Germany all really pitching in has destabilized markets quite a bit. So for the first time in quite some time, we've seen a link to the 10-year Treasury yield, all right, so long-term interest rates, mortgage rates as well, kind of turning over. Now, if we went back to the same time period since January, the 10-year has just been on an up. Even though we saw the stock market rise and then now fall, what we're seeing is the typical correlation between bonds and stocks or equities is that as people sell their equities, the stock market's falling, that tends to decrease interest rates because the investments into these long-term Treasury, these guaranteed, they're guaranteed by the U.S. government, start to turn over. So we've talked a little bit about Treasury yields overall across the board down today. We've got the 10-year down to 2.76, the 2 years down to 2.56, nowhere near an inversion, but we still have seen the 7-year yielding a higher return than the 10-year. So that's still something to keep an eye on. In the big scheme of things, I'm going to dive in a little deeper on mortgage bonds. The good news is that mortgage bonds, the price to the mortgage bond, which results in a yield. So as the price has been falling, the yield to the consumer has been rising. So if we just total inverse of what I showed you on the 10-year Treasury a moment ago, we've seen a bottom start to form, and we've seen it kind of bounce back. Now today in particular have gone up. It's been a lot more room for it to come back close to this 25-day average, but we would have to see a significant turn. We've seen this kind of a bottoming out before. Back March 28th, we saw a bottoming out and then turn around and had lower prices, higher yield. And just to recap that, as we compare the same time period on the 10-year Treasury, we are starting to see what could be a turnover, but that doesn't mean it's guaranteed. And we can see the turnover has happened before. We've seen it top out, then we've seen it continue to rise. So when will we see the high, and as far as rates go right now for this summer? There's just no way to know. Hopefully we'll see heightening of the rates and a turnaround. If stocks start to come back, and if you see stocks bounce higher again after this week's fall, the S&P 500 was down, the Dow Jones was down almost 500 points today. The other indexes, the tech indexes, are all down. So as we get into this week, we'll hope that this turnaround in stocks can result in relief from the pain on mortgage rates. Have a great week.